Hi, things don't look too great in crypto land. I was thinking about making an altcoin video, looking at the top 100 coins, but really this doesn't seem to be the time to trade altcoins. Among the top 100 coins, we only have 3 cryptos, Cello, AVAX and Shiba Inu, that made some kind of gain in the last 7 days. The rest all lost money. And so some people might argue this is exactly the time you should buy, right? Buy when there's blood in the streets, be greedy when others are fearful. But I'm not certain that crypto really works that way. Buying the dip does not always make sense. It only makes sense when overall momentum is still bullish. Because momentum in crypto is a real thing. I've talked about this moving average trading strategy quite often on this channel, but I always focus only on 2 moving averages, right? The 23 and the 39 day. But there's actually way more behind this chart than only those 2 moving averages. So the general idea, just to recap, is that you go outside of the market when the price tends to decline, right? So in this case, we've got Ethereum. When the price is below the moving average, we are completely in cash. So the portfolio line here is flat. Whenever the price is above the moving average, we get into the market, we buy, and we follow the price movements. So it's a very straightforward momentum following strategy. Because what this does is, whenever the price tends to rise, we jump on the train. Whenever the price tends to fall, we get out. So when there's a dip that's strong enough, we're doing the exact opposite, right? We are not buying here, we are selling. We take momentum seriously. And this effect is not just specific to those 2 moving averages. So when you backtest this, the 23 and the 39-day moving average, they worked best for Ethereum. But look at the returns for all the other moving averages. So this is buying and holding during that period. You would have gotten 56% per annum on Ethereum. But look at the other moving averages. Maybe forget about the 2 and 3-day moving average. These are very short term. But look at everything that comes afterwards. No matter what moving average you take here for this trading strategy, no matter how you follow the trend, unless you're really slow in reaction time and you go like to the 1-year moving average, if you're somewhat reactive to the market, it almost does not matter what moving average you take. You do get higher returns per annum. Now, given these are backtests without any trading fee, so if you're trading on a decentralized exchange with small amounts, you are unlikely to replicate this exactly. But the point I'm trying to make here is that momentum is a real thing. If you look at the time frame between, say, 4 days and 1 year, you should really go with the market. You should really follow the market. If times turn bearish, it makes sense to be bearish. If prices consolidate and tend to move up again, it makes sense to be bullish again. Here's the same data, just displayed slightly differently. Buying and holding would have given you 56%, so that's somewhere around here. And no matter what moving average you take, so on the x-axis we've now got the moving average duration, no matter what moving average you take, you tend to outperform this 56% per annum performance. So really you want to follow momentum on any kind of medium time scale. And that's not just to make more money, but that's also to protect yourself against the downside of crypto. Because crypto can really be very, very brutal. You have to find ways to protect yourself, for example, with stop losses or with diversification to other asset classes. You should have stocks as well because they are lowly correlated. But you see, Ethereum in the last crypto winter went down by 94%. So really you don't want to have 60-70% of your money in Ethereum and altcoins. And once it goes down, you lose everything, right? You really want to have a strategy of when to exit the market, or at least if you decide to hold on for dear life, to reduce your overall portfolio risk by owning also some stocks, some property, maybe some precious metals. I'm not a precious metals fan, but still, you need to have some diversification. And as we can see, diversification does not happen within crypto. Everything is going down at the same time. Crypto assets among themselves, they are highly correlated. So are stocks. So it doesn't matter if you own Apple and Facebook and Google and Microsoft and maybe even a different industry, maybe even Disney, Procter & Gamble. All of those stocks, they go down at the same time when there is a crash. But a crypto crash does not necessarily have to happen at the same time as a stock market crash. I think that's also a very wrong perception overall within crypto. A lot of people think stocks and crypto are highly correlated, but that's not really the case actually. The correlation coefficient between stocks and Bitcoin, so here we've got the S&P 500, the daily returns over a 2-year period. So this is a 2-year window. Each of those points measures the correlation coefficient of daily returns for the last 2 years. So we roll this 2-year window over the entire history of Bitcoin, and we can see the correlation coefficient is relatively low. It's somewhere around 0.2, 0.3. So stocks and Bitcoin, they don't necessarily move in the same direction at the same day all the time. The correlation coefficient is low. This is Apple to the overall stock market. So we are here looking at 0.7. 1 means the assets move always in the exact same direction. -1 means they always move in opposite directions. And you definitely don't want to have 1 as a correlation coefficient or 0.7. Say you've got one asset over here in green, another asset that tends to move the same, is maybe just slightly different. Once you combine a portfolio out of those two assets, right, let's say with equal weighting, so your portfolio line would look maybe something like that, then it doesn't really matter too much if you only own one of those assets or if you combine them in a portfolio, because in the end your portfolio volatility will still be quite similar to each of those individual assets. So when the assets crash, your overall portfolio crashes as well. But say you've got low correlation and your second asset might even move in opposite directions. Say when one asset goes up, the other asset tends to go down and vice versa. So you've got something that looks like that, still appreciating over time, but the short-term volatility tends to be opposite of your existing portfolio. If you now combine them in a portfolio, you get a line that cancels out each other's volatility. So that's nice, right? You get an appreciating portfolio without all the price risk. And that's exactly what you want. You want to combine assets with low correlation. And the best way to do this is to simply invest in different asset classes. And that's mainly stocks, crypto, and property. There is, of course, somewhat of a correlation during large events, right? During liquidity crunches. This crash over here in 2008, this was not a stock market crash, right? This was in the end a property-induced crash. A lot of leverage, a lot of malinvestment in property, that led to financial institutions getting in trouble as well, which then caused a stock market crash. So obviously there is some kind of correlation between the asset classes as well. You can't completely get rid of this, but at least you can reduce your risk somewhat. And the nice thing about diversification between different asset classes is that this kind of protection doesn't cost you anything, right? You basically get this additional security for free. If you buy 100% this or 50% of each of those, if you ignore transaction costs, this is basically a free cancellation. This risk reduction is basically free. You cancel out these price risks for free. And so the correlation between Bitcoin and stocks is still low. It really makes sense to own both. And owning both is one way to reduce your risk. Another way to reduce your risk is to follow momentum, especially with your risky bets. Maybe not necessarily with Bitcoin. If you believe that Bitcoin will be at 1 million in 10 years, then why trade in and out of this all the time? But for the risky bets, for the altcoins, right? And I would, for example, still regard Cardano as a risky bet because there's no ecosystem yet, right? There's a smart contract launch, but people don't really actively use this for NFTs or for DEXs or anything like this, right? It's still a very early stage project. And Cardano went down in the first crypto winter by 98%. Something like that. So I'm not saying a 98% drop will happen again, but it's simply the kind of magnitudes, the kind of price swings that you see in altcoins that you have to be aware of. And you want to follow momentum for these risky bets. Because momentum is a real thing. Prices that used to rise tend to continue to rise. Prices that used to fall tend to continue to fall. Otherwise, the returns per annum here, they would be lower than those 56% in some of those cases, right? But we basically get the confirmation that no matter what time frame you look at, something that went up in the last 50 days is likely to continue to go up. And when it went down in the last 50 days and the price is below the moving average, it's likely to continue to go down. And so you should be in cash. So for risky altcoins, take momentum seriously. Don't just blindly buy the dip. Now, the current situation in Ethereum doesn't look too positive, right? Momentum is not positive at all. we are below those two moving averages, the 23 and the 39-day moving average, the ones that work best for Ethereum. And so I'm waiting. I'm not going to buy now this dip. I'm waiting until we consolidate again and then cross those two moving averages and potentially rise, another 60% or so. But if you simply look at the past, these kind of movements, they can be ugly. But still, even those two moving averages, they tend to work best when you backtest this for Ethereum. They are not perfect either, right? You get wrong signals. This has been a bullish signal, but then we fell below again. This was a sell signal. Then we got another bullish signal. So sometimes we do hover around the moving average and we sell and buy and sell and buy all the time. But it's the best we've currently got, at least if we use this approach. So I'm simply cautious, which doesn't mean that this must be the right approach, right? It could go up from here. Who knows? One interesting statistic that you might or might not know is also the performance of Bitcoin by month of the year. And September seems to be somehow a cursed month. Maybe because in general, attention on crypto is low during September, August and September. But once people are locked inside again, once the winter is coming, people are in front of their computers more often. So maybe then crypto activity peaks up again and prices rise. At least that's what happened in the past, right? Q4 tended to be really positive for crypto. Doesn't have to happen all the time, right? Q4 in 2018 was not the best time for crypto, right? We went down 43%. But yeah, these are just averages. And September tends to be bad and the following month tend to be positive. But still, I don't think it's a good idea to simply buy because it's the 1st of October. I think it does make sense to wait until momentum is positive again, because momentum in crypto is a real thing. And reducing risk, reducing the maximum drawdown from the top to the bottom, especially for risky altcoins, does make a lot of sense in my opinion. If you enjoyed this video, please give this a like. YouTube will then help to grow the channel. And if you haven't yet, feel free to subscribe as well. I publish a video every single day. Last but not least, feel free to join our Telegram channel. We are currently around 700 people. You can find us either by searching for Bitcoin Strategy Channel within the Telegram app or by clicking the link in the video description. See you next time. Bye bye.